In a major shift for global aviation, Airbus CEO Hermy Fory has announced the company will stop selling aircraft in the U.S. This comes in response to sweeping tariffs imposed by newly elected President Donald Trump, who aims to use import duties to boost American industry. The move marks a dramatic turn in transatlantic trade and highlights rising protectionism. Airbus's exit severs a long-standing economic link. For decades, it competed fiercely with Boeing in the U.S., not just for market share, but for prestige and innovation. American airlines, both major and regional, have long relied on Airbus aircraft for fuel efficiency, comfort, and advanced tech. The decision to pull out signals a deep shift in trade dynamics and airline strategy. The Trump administration's tariffs are broad, targeting a wide range of imports, especially from economic rivals like the EU. Airbus, rooted in France, Germany, Spain, and the UK, is squarely in the crosshairs. For Fory and his team, continuing U.S. operations under these tariffs would mean steep losses or becoming irrelevant, neither acceptable for a company of its size. This isn't just a company move. It reflects a larger reshaping of global commerce. The tariffs aim to protect U.S. manufacturers, giving Boeing a clear edge at home. Supporters argue this will boost domestic jobs and restore industrial self-reliance. But Airbus's exit cuts competition, a blow to U.S. airlines, which have benefited from having two major aircraft suppliers driving prices down and innovation up. With Airbus gone, Boeing faces less pressure to compete. While that may seem like a short-term win, it risks stagnation. Meanwhile, the global supply chain feels the strain. Airbus has invested heavily in U.S. facilities, especially in Alabama, and relies on American suppliers. Tariffs now threaten those links, risking layoffs and factory closures. Airlines that plan fleets around both manufacturers will need to rethink strategies. They may face higher costs, delayed upgrades, and fewer options, especially those banking on Airbus's next-gen fuel-efficient jets. These challenges could trickle down to passengers through reduced flight options and rising fares. For Airbus, this is a tough but necessary pivot. Fory has made clear the company won't absorb the high cost of U.S. tariffs. Instead, it will refocus on markets in Asia, Latin America, the Middle East, and Africa, seeking growth where trade conditions are more stable. Airbus's withdrawal from the U.S. market, triggered by the Trump administration's tariffs, has introduced new strain in U.S.-Europe relations. For years, transatlantic ties have been shaped by a blend of cooperation and rivalry, particularly in high-tech sectors like aerospace. This move is likely to be seen in Europe as a provocation, possibly sparking reciprocal actions and weakening cooperation at a time when unity is increasingly vital. The consequences may extend beyond aerospace, risking a wave of retaliatory tariffs that could disrupt global trade and stifle the free flow of goods, services, and innovation. In the U.S., the immediate reaction might be optimism. Airbus's exit could mean more business for Boeing and its suppliers. But the long-term effects are more complex. Reduced competition could limit innovation and lead to higher costs, while supply chain disruptions may hurt U.S. businesses that previously relied on Airbus. Politically, the move aligns with President Trump's economic nationalist agenda. His supporters may view Airbus's exit as proof that aggressive trade policies work. Critics, however, argue the risks, retaliation, reduced innovation, and weakened global supply chains could outweigh any short-term gains. This development may also reshape how global companies view the U.S. market. Historically a prime destination for international business, the U.S. now risks appearing unpredictable and less open. If Airbus can be pushed out, other firms may reconsider their strategies, potentially shifting investments elsewhere. Beyond the business implications lies a broader philosophical shift. The U.S., long a proponent of open markets, appears to be retreating from the principles of free trade and global cooperation that defined the post-World War II era. The impact of this shift may be felt for decades. Inside Airbus, the decision to exit the U.S. wasn't made lightly. CEO Fory must now navigate the fallout, recalibrate global strategy, and seek growth in less restrictive markets. This could mean investing in regions with fewer trade barriers, strengthening partnerships in emerging markets, and accelerating innovation. the broader aerospace industry will feel the ripple effects. Airbus and Boeing's rivalry has driven major advancements in aviation. Without that competition, innovation could slow, leaving room for others, like Embraer or Chinese and Russian firms, to gain ground. The result could be a more fragmented, less dynamic industry. From a geopolitical standpoint, Airbus's exit underscores deeper cracks in the global trading system. Trade wars, once rare, are now real. Tariffs are being used as tools of economic policy, challenging decades of multilateralism. Europe will likely respond. Given Airbus's symbolic role in European industry, governments may increase support through R&D funding, new trade partnerships, or legal challenges at the WTO. Whether these efforts succeed remains uncertain amid growing nationalism and skepticism toward global institutions. For U.S. consumers, the effects may be subtle but real. Fewer choices for airlines, less innovation, and potentially higher travel costs. Over time, the lack of competition could degrade service and slow progress. The symbolism matters, too. For decades, the U.S. championed free markets, forcing out a major competitor through policy, not performance, signals a shift. It suggests that success in the U.S. market now hinges as much on politics as on quality or innovation. In the end, this episode reflects the growing tension between protectionism and globalization. Airbus's departure marks a turning point in the aerospace industry and signals broader changes in international trade dynamics, with wide-reaching consequences. The relationship between governments and multinational corporations has always been a mix of cooperation and conflict. Airbus's decision to exit the U.S. highlights how political moves can derail even well-established business plans. For years, Airbus built strong ties with American airlines, suppliers, and local leaders, especially through its plant in Mobile, Alabama. That presence signaled long-term partnership. But new tariffs have thrown that commitment into question. The impact is being felt across the U.S. aviation sector. Without Airbus in the mix, airlines that once balanced their fleets between Airbus and Boeing must now rely heavily on Boeing. This shift complicates everything from pilot training and maintenance to route planning and inventory management. Adjusting to a Boeing-heavy fleet won't be quick or cheap. Airbus's U.S. workforce and suppliers are taking a direct hit. The Mobile facility, a source of regional pride and economic stability, now faces job cuts. Suppliers who depended on Airbus contracts for survival are scrambling, with few easy alternatives in such a specialized industry. Globally, the aerospace landscape is shifting. With the U.S. market off limits, Airbus will likely focus more on Asia, especially China and India, where aviation demand is booming. But expanding in these markets brings new challenges, including tough regulations and local competition. Boeing stands to gain from Airbus's exit, at least in the short term. Without its European rival, Boeing could dominate the U.S. market. But that kind of dominance risks complacency. Airbus's competition pushed Boeing to innovate. Without it, progress may slow. Meanwhile, global rivals like China's COMAC and Russia's aerospace sector may seize the opportunity to partner with Airbus, strengthening their own positions and challenging Boeing's global lead. International airlines now face a more complicated operating environment. With tariffs in place, they must rethink how they buy aircraft and structure their global operations. Fleets may become more region-specific, reducing efficiency and scale. The Airbus exit has reignited debate over trade policy. Supporters of U.S. tariffs argue they protect domestic jobs and industries from subsidized foreign competition. Critics warn they damage long-term competitiveness, disrupt supply chains, and provoke retaliation. The human cost is real. Workers and communities that relied on Airbus are now facing layoffs and economic decline. Training programs linked to Airbus may lose funding, shrinking the pipeline of skilled aerospace workers. Environmental progress could also suffer. Airbus has led efforts in greener aviation, hydrogen fuel, sustainable fuels, and better aerodynamics. With fewer Airbus planes in the U.S., American airlines may slow investment in clean technologies. Markets are reacting with uncertainty. Stock prices for both Airbus and Boeing are volatile, and analysts are struggling to predict long-term effects in such a politically charged environment. Airbus will likely ramp up efforts in Latin America, Africa, and the Middle East, offering financing and partnerships to grow its presence. These moves won't fully offset the U.S. loss, but they may keep Airbus competitive globally. In Washington and Brussels, this episode is reshaping debates around trade, industry, and economic security. U.S. lawmakers must weigh the costs of protectionism, while European leaders may push for more strategic autonomy and internal demand. Multinational companies are now rethinking how they manage risk. Stable market access can no longer be assumed. Flexibility, diversification, and geopolitical awareness are essential. Airbus's exit also touches on national pride. For Europe, success in the U.S. was a validation of its industrial model. Its retreat feels like a loss. In the U.S., some see it as a victory for domestic strength and economic self-determination. Long-term, the aerospace workforce could face big changes, more automation, relocation of jobs, and a focus on emerging markets. The Airbus story is a warning to other industries. In today's geopolitical climate, adaptability is key. No market is guaranteed,